Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So let me give you just a definition of calendar spreads specifically, and then we'll do some profit and loss charts, and we'll do some calculations, and then we'll look at some actual examples. So a calendar spread is what's also known as a horizontal spread or a time spread. All three of those things are synonymous. So if you hear those terms, they mean basically the same thing. I personally prefer the calendar spread term, but it doesn't really matter. If you want to use horizontal or time spread, that's fine. A calendar spread, as Steve mentioned at the beginning, is a strategy that has a limited loss, and you also get a limited gain. Most spreads are set up that way. Not all spreads, but the vast majority of all spread strategies that you'll find are designed such that you can make a certain amount of money, and it's a maximum profit amount, but the benefit to the real benefit to the spread is that it also has a maximum loss amount. And it's very nice when you make any sort of trade to know how much you can potentially lose. That shouldn't be your only consideration, but it absolutely should be a consideration before you put a strategy together. A calendar spread, by definition, is purchasing an option with a long-term date until expiration, and that might be 2 months out, 3 months out, 4 months out. It could be any number of months out, as long as it's not the front month. And then you sell an option for a closer month. So if I buy an option that's, say, an April contract right now, I would need to sell in March. That's the only way I could create a calendar spread. Now, it's critical for it to be considered a legitimate calendar spread, a true calendar spread by definition, and for purposes of margin calculations based on the way option industry rules are set up, you have to buy the longer dated option and sell the shorter dated option. I can buy one that's 9 months out and sell one that's 8 months out, 7 months out, 6 months out. It doesn't matter the difference between the 2 months. It doesn't matter how far out I go, but it's critical that I buy the one that's further out and sell the one that's closer out. And I think this speaks a little bit to one of the questions that came in here early on, and that is you can create what is perceived to be a calendar spread by selling a longer-term option and buying a nearer-term option. And if you want to view that or perceive that for strategy purposes as a calendar spread to yourself, you're welcome to do that. But the way margin calculations are done based on the way option industry rules are set up, that won't be treated as a calendar spread in your brokerage account. Your broker is going to be required to treat the short leg of that spread as a naked option. And the requirements for margin go up dramatically when you do that. If you have the longer leg as the longer dated option, the margin requirements are a lot lower. The margin requirements essentially are based on the maximum loss in the account, the maximum risk that you could sustain on that strategy, and it's going to be significantly lower. Your broker may also have a higher requirement in terms of account equity, in terms of potentially an options trading approval level, all sorts of things that you'll have to deal with if you create the reverse or the backwards calendar where you've got this short leg as the longer dated option. So for purposes of this particular presentation, I'm going to be speaking strictly to definitionally accurate calendar spreads. That is where you buy the long term and sell the short term. That's not to say, again, for your own purposes that you couldn't do it the other way, but this is the strict definition of the calendar spread. Now, a true definition of a calendar spread also involves that both options are either calls or puts, not both, and that they have the same strike price. Now, there are all sorts of other option strategies that vary on those two factors. Again, we've got 2 separate expiration months. The long one has to be the later expiration. The options have to be either both calls or both puts, and the strike prices have to be the same. If it meets all 3 of those definitions, then it's considered a calendar. If you have both calls and puts, it's not going to be a calendar any longer. A calendar spread is probably some sort of straddle, potentially a butterfly, something like that. If you have multiple strike prices where the one you buy and the one you sell are different, it's not considered a calendar spread any longer. It's considered a diagonal spread. And that's a fully legitimate strategy, and it may make very good sense, but it's not one of the topics we're going to talk about today because, frankly, we just don't have the time to go into that. Maybe we'll do another session later on diagonals, which are a variation on calendar spreads. Now, what's interesting about calendar spreads is that, again, if they meet those strict definitions where you buy the longer option, you've got the same strike price, and they're both calls or both puts, is that a calendar spread is always entered at a net debit. And that's especially true on these currency options. Now, there is a single exception to that, and that's volatility options, which, again, we're not going to go into today. But they're a very different animal. But for all options that you've ever seen, with the exception of anything based on specifically on volatility, a straight calendar is always going to be done at a net debit. And the reason for that is simply that if there's no difference in terms of the value of the option based on whether it's a call or put, and there's no difference in terms of the value of the option based on the strike price, the only difference between the two options is the expiration dates. And most of you, if you know anything about options, you know that part of the value of an option is based on the length of time until the option expires. And if you're buying one that expires at a later date, you have to pay more for that option because it has more what we call time value. So it's always done at a net debit. What's neat about that is that calendar spreads, like many other option strategies, if they're done as a net debit, the net debit is the amount that you can lose, and that's it. You can't lose any more than that. And we're going to go into the calculations on exactly how we come up with that a little bit later. Now, what's neat, as Steve mentioned earlier, is that a calendar spread primarily is a neutral sort of, well, I would say it's a relatively neutral strategy. But what's interesting about calendars, and what I think makes them a little bit complicated, not that they're too difficult to understand or anything like that, but I think calendars are far more difficult to understand and to deal with than a simple vertical spread where you've just got a difference in strike prices. And the reason I say that is because most strategies have a particular sentiment. You can have a bullish debit spread or bearish debit spread. Typically, there are 4 different sentiments that are involved in options trading. You're either bullish, you're bearish, you're neutral, or you have what we call a breakout position, which is you don't care which way the stock goes as long as it goes one way or the other. But what's interesting about calendars, at least one way to look at them, the way I like to look at them, is that they have 2 sentiments. They have a short-term sentiment, which is between now and the date of the first option expiration, and they have a longer-term sentiment, which is essentially any time after the first expiration, typically all the way out to about the expiration of the longer option. So there's 2 separate time frames there, and you can modify this strategy based on the strike prices you use, based on whether you use puts or calls, to make those 2 sentiments any different than you want. You might be bullish near term and bearish long term, bearish near term, bullish long term, neutral near term, bullish long term. There are all sorts of different combinations of bullish, bearish, and neutral that you can come up with. I guess there's 9 if you think about it, of different ways that you can do this. So I think I'm going to go through, I think, 4 separate examples, and we're going to go into those a little bit and look at some that are a little bit different and some that are similar on a couple of these different pairs. And you can put that bullish or bearish spin on them, again, based on whether you use puts or calls, not strictly just puts or calls, but also based on what strike prices you choose.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.